Right now, global capital markets move trillions of dollars into infrastructure every single day. Yet, right next to that massive flow of wealth, our critical water systems are starving for funding. The World Economic Forum has quantified the problem. We face a $13.2 trillion gap in global water infrastructure funding. Institutional investors control massive pools of sidelined capital. Despite this, less than 15% of water infrastructure development actually gets funded by private markets. We possess the physical engineering technologies to purify and distribute water. The barrier keeping the capital out is a failure of market design. Mobilizing private wealth at scale requires institutional-grade financial plumbing to match our physical engineering. Look at how legacy water sourcing operates today. Rural well systems operate in total isolation, dependent on highly localized, undocumented variables. On the other end of the spectrum, major industrial desalination and filtration plants operate as highly complex, one-off engineering builds. Every installation relies on bespoke contracts, unique technical specifications, and completely opaque performance data. Institutional banks and fund managers operate at a macroeconomic scale. They cannot mathematically underwrite a portfolio built on millions of unstandardized, hyperlocal variables. Institutional capital stays away from water preservation because it cannot model and manage unstandardized risk. When most people hear the word commodification applied to water, they picture corporate hoarding and the reckless commercialization of a life-giving resource. In capital markets, the term means something entirely different. It is the structural process of translating a messy, unpredictable local resource into a universally understood package of trust. This visual lays out the 4 structural pillars required to mobilize market capital. An asset requires standard units, quality certainty, frictionless clearing, and price transparency. When you enforce these 4 pillars, the data shows exactly how the market reacts. First, enhanced market transparency causes a direct 50 to 100 basis point drop in end-user transaction costs. Next, the creation of standardized cleared contracts drives a 50 to 70% reduction in trading bid-ask spreads, drastically lowering structural friction for institutional desks. Finally, replacing opaque backroom negotiations with a centralized public format eliminates vendor informational asymmetry. That results in a 31% decrease in baseline pricing. These metrics explain why private capital flows in. A fund manager doesn't need to inspect the mechanical intricacies of an industrial pipe network. They just need to see a standardized contract with a transparent market price. Standardizing risk in this mechanism is the absolute prerequisite for turning any raw material into a functional, bankable asset class. We have a clear historical blueprint for this transition. Over the last 2 decades, the renewable energy sector proved this exact model works. In the early 2000s, solar and wind installations were treated exactly like water projects are today. They were viewed as highly risky engineering experiments, dependent on volatile government subsidies. The energy market solved this by unbundling the data attributes of clean power. They'd established standardized renewable energy certificates and power purchase agreements. This chart tracks the consequence of turning green electrons into a cleared commodity. In 2004, the baseline global capital allocation for transition energy set at roughly $50 billion. As standardized contracts rolled out, that private capital pipeline expanded. Between 2004 and 2024, global investment in renewable energy skyrocketed past $600 billion annually. That immense scale triggered a unit cost flywheel. With automated manufacturing and predictable financing, the lifetime cost of utility-scale solar plummeted by 89%. In that same timeframe, the unit cost of onshore wind power crashed by 69%. Market standardization creates a compounding economic engine capable of taking expensive technology and turning it into the cheapest source of bulk electricity in human history. To solve the global infrastructure deficit, Kreneon is applying this exact historical blueprint to the water crisis. The protocol translates local water production into a globally clearable financial asset without ever moving the physical water. Step 1 begins at the production site. Secure, real-time hardware sensors attached directly to storage tanks to validate exactly how much water is manufactured, along with its precise environmental attributes. The system then executes a process called data attribute stripping. It isolates the physical molecule of water from its digital environmental data. In Step 2, the physical water stays exactly where it is. It flows downward through the local utility pipes to service the surrounding community off-takers. In Step 3, that verified digital data is stripped away and packaged upward into a universally understood financial contract. We call this tradable digital asset a Virtual Water Purchase Agreement, or VWPA. This standardized contract carries all the verified production attributes and can now be traded, verified, and settled digitally across international clearing systems in seconds. Unbundling the molecule converts a heavy, stationary, highly localized physical resource into a liquid, universally tradable financial asset. To see exactly how this restructures project economics, let's look at the opposing balance sheets of an industrial buyer and a local infrastructure supplier. First, the buyer. A major industrial manufacturing firm needs massive volumes of water for its production lines. To maintain its social license to operate, the company commits to a strict zero water loss target. This decision tree maps the financial friction they face. Without a commodified market, the buyer is forced down the legacy path. Building bespoke water infrastructure forces the manufacturing firm to absorb a heavy $10 to $20 million upfront capital expenditure directly onto their local balance sheet. If they take the Kreneon path, the firm subscribes to a digital registry and purchases standard lots. This converts a massive CapEx liability into a smooth, predictable, audit-proof operational expense. Now look at the supplier. This is an engineering firm building off-grid desalination networks. Under the legacy system, a commercial bank will deny them an infrastructure loan because the long-term local cash flow is uncontracted and highly risky. With the registry live, the supplier pre-sells the environmental data attributes of their future water output via forward VWPAs, selling directly to that highly capitalized industrial buyer. The supplier walks back into the bank with an ironclad corporate offtake agreement. De-risked by corporate credit, the project's weighted average cost of capital drops by 200 to 300 basis points, instantly spiking its net present value and internal rate of return. This mechanism uses high-grade corporate credit to de-risk local infrastructure. It provides the bank capital developers need to recycle their funds and multiply their installations. By connecting these isolated water projects to a planetary financial grid, it scales this economic flywheel across the globe. Commodification is the necessary institutional plumbing required to financially reward resource generation. This chart projects the macroeconomic outcome. Public price discovery removes underwriting uncertainty, generating a direct 4x to 5x surge in private capital deployment. Furthermore, standardized playbooks activate a 9-to-1 leverage ratio, where every anchor dollar mobilizes $9 of institutional co-investment. Simultaneously, introducing transparent asset registration and derivative clearing networks stabilizes long-term supply expectations, suppressing cash market volatility by 17%. Standardizing risk for institutional markets is the primary mechanism required for closing the massive $13.2 trillion funding gap, moving past a reliance on grants or subsidies. Converting verified water data into a liquid asset class effortlessly aligns industrial demand with global planetary survival. This market design upgrade addresses the structural failures of the current water economy.